Hi, I'm Dorothy Neufeld with the Investing News Network, and here with me today at the Extraordinary Futures Conference is Ryan Irvine, founder of KeyStone Financial. Thank you for joining me today.
It's nice to be with you again here at Investing News Network, for sure.
So to start off, can you tell me a little bit about what you do with KeyStone Financial?
Well, I think one thing that we try to do as a basic level is for our clients, we have clients across the country who pay us to find the best small cap and dividend paying stocks, all cash producing businesses. We try to simplify the markets for our investors. Look at investments or investing in stocks like they're not just a symbol, but an underlying business. And then we help them kind of on a DIY basis build a simple 10 to 25 stock portfolio, individual stocks. They pair our service with a discount brokerage. All we do is give them the exact buy, sell, hold advice from our painstaking research on all these companies. We literally go through all 3,500 companies in Canada and over 3,000 in the US to find about 8 to 10 stocks in any given year. So that's what we do for our clients. They just pay us for our research. We're completely independent. We don't get paid by the companies that we recommend. We don't do financings for the companies that we recommend. So our sole goal is to find the best producing stocks and producing in terms of returns for our clients over the long term. That's the way we structure it. I think it's a good model. It's fairly unique in Canada. It gets us more business because it is unique. I don't want too many people to follow it. I don't want competition. But I think, and the main thing is for our market is the returns over time. And we can talk today about, we were at this event last year, the Extraordinary Future, and we recommended 5 stocks. We can go into those, or whatever other questions you have for me today, we can go into that.
Sounds fantastic. Because last year you made some recommendations. Can you talk about some of the performance you've seen?
We made 5 recommendations at this conference last year. 4 of them were up, which is a good 4 out of 10. The one laggard is down about 5.5%, and it pays us a 3% dividend, and we'd recommend it today. But the 4 stocks that were up, the average gain was 50%, 50.2 to be exact. Now, the Toronto Stock Exchange over that period is up about 4%. Now, these are small cap companies that we're recommending, so our benchmark would be more the Russell 2000 index, which is the North American 2000 small cap companies. Now, that is actually down 7% over that period. So if you're able to gain 50% in a period when your peer group is down 7%, I mean, the proof is in the results. That's what we try to do. You can't do that every year, but we're going to apply the same type of criteria to finding new companies going forward. There's 4 winners. One of the companies was XPEL Inc. Its symbol is XPEL on the NASDAQ. This time last year it actually traded on the TSX Venture, but they graduated to the NASDAQ, have reported several quarters of record earnings, 4-fold increase in earnings since we recommended them 2 years ago. That stock is up from $1.40 to around the $11.50 range right now over a 2-year period, about 730% return. Absolutely boring business, I have to say. Like, I just love the underlying cash flow in the company. All they do is make a tiny little film that you put on your vehicle aftermarket, and it prevents those annoying scratches and dings you get from rock chips or like somebody bumping up to keying your car. So it helps prevent those. They do a little window tinting as well too. But you know, it's a great business, great growth in the underlying cash flow. They're in Canada, in the US, in China, in Europe, in Latin America. So it's, you know, it's not a tiny company, but you know, there's good solid growth prospects ahead. Obviously it's not cheap now compared to where it was 2 years ago, but their next quarter should see accelerated growth. We continue to hold the shares right now. We haven't sold any, so we'll hold them. We think it's still growth at a relatively reasonable price. You want to talk about some other companies that we talked about too?
Absolutely.
Just keep going, right? Keep going.
What are some variables that you're watching?
That we look at? When we look at, well, I think that, you know, every company is unique, but when I can give you an idea of what we do when we look through our 3,500 companies in Canada. The top line we look at is revenue. If it doesn't have revenue, we swipe left. Is it swipe left? I can't. I'm not on a dating site. I should maybe. No, kidding. My wife would not like that. So I swipe left, and that's what we do. If you don't have revenues, if you don't have a bottom line, we go to that. Well, if you have revenues, and then if you don't have cash flow, then we can move to the next level. Do they have a good balance sheet? Do they have, is there growth in the revenue? Is there growth in the cash flow? And if we get to that level, already if we've done that, we've dismissed about 80% of the companies in Canada, which is kind of a sad reflection that our markets are really resource-based, and some financials. Financial, there's some profitability, but resource, there's a limited amount of profitability. So we can get rid of those. We concentrate on about 350 companies that we can really dig into. Then we start interview management teams, look for the outlook. Are they guiding towards growth going forward? And if we can find that, then we may have a company that we could potentially recommend to our clients. If we can find growth at a reasonable price, then we'll do that. Marry those two concepts together.
So last year you said that you were not investing in the cannabis space.
Yes.
Can you tell me more about this?
I'm absolutely nothing against cannabis or anything like that. Like I said, I'm a slave to cash flow, right? So we went through all 120, if you can believe there was 120 related that are publicly listed companies in Canada. It took about 2 months. Went through the MD&As, management discussion and analysis. Looked at some industry metrics, like we looked to see if there's going to be oversupply or undersupply. In our opinion, we saw a situation where the top 10 producers were going to, they had productive capacity coming online in the next 2 years that would exceed the demand in Canada for cannabis by about 2.1%. That's not a good scenario for us when you see capacity coming online that's going to exceed demand. That leads to shrinking margins over time. So that's our general negative outlook on how much capacity has come online. That is because it's been really easy. It's been a hot sector. It's been great for some investors, not over the past year, but it's been easy to raise capital. And to be honest, and some people will quibble with me on this, it's not the toughest thing to grow or the toughest crop to grow. Some of the dumbest people I know can grow it in their basement fairly easily. I'm going to get flack for saying that, but it's not really, it's not the toughest crop to grow. So we see an oversupply situation, right? The other thing is we want cash flow. The underlying businesses weren't producing cash flow at the time. I wanted to come out, our team wanted to come out with a recommendation in that sector so we could participate in what we saw as a growth industry going forward. Couldn't find the cash flow. We're not going to move outside our box that we look at in terms of our criteria. And we may in the future invest in a company in that sector. I still can't find a company right now that checks off all our boxes. Now, this time last year, like Canopy Growth, which is the biggest name in cannabis in Canada, in the world, you might say, in the public markets. From this time last year, it's down 42%. Tilray is a company which was much hyped at this time last year. It's down 82.5%. Green Organic Dutchman down 72% over the past 52 weeks. I can go on and on. It has been a great area to destroy your capital over the past year. Now, we have a book on most of the companies in the industry. If one comes into our box that we like to recommend, then it may be a company that we present to our clients across the country. It's not there right now. So we're still avoiding the sector. Not avoiding it, we're still not finding value in it right now.
Interesting. And in terms of the overall small cap tech sector, what are some things that you're seeing? Well,
I think in Canada we are woefully underrepresented in technology. It's just around 5% of the market. Where in the US it's 20+%. So for us to find a good solid technology company, we're usually looking down to the US. We can find some really unique situations in Canada, but there's we're 50% resource and financials in Canada on the markets. It's just a structural problem with our markets, right? So we would love to see, a conference like this is great to promote the tech sector generally, raise the profile of it, hopefully, and marry that tech sector with the public markets. I think in Canada right now, we do a really poor job of getting great innovative tech companies and bringing them onto our public markets. For example, I'll give you, blockchain was much talked about in our industry heading 2017, 2018 with the cryptocurrency craze and everybody trying to learn about that sector and wanting to invest in it. So we were learning about it ourselves, and there was about 38 companies that we could find in North America that were publicly listed. There's 3 of them that have revenues on a quarterly basis, so every 3 months that were over 100,000. That is a small amount of revenue. It's uninvestable for us at that stage. Now, 2018, so this past year, the returns of those 38 companies, they were down 80%. So there was a much hyped sector, And by the time it's overhyped in the public markets, it's probably not the greatest time for the average investor to be investing in. So our cash flow analysis leads us to say this sector was uninvestable for us at that time, and we would save our clients, an 80% loss. That can be catastrophic to a portfolio. So, and over that time, we've recommended some of the most boring companies in Canada, I would probably say, and they've been performing well. They're not all boring, obviously. There's some companies. I love to marry a hot sector with a great value. It doesn't always happen, but if you can do that, you can have explosive returns. But you can also have explosive returns by buying just great businesses that produce good returns over time. Can I ask you a question? Can we do that?
Absolutely.
You don't have to get the answer right, but do you know the best performing stock on the Toronto Stock Exchange over the past 10, 11 years? So a decade and a little.
I don't.
I asked the same question to 500 people in Toronto this time last year. I got crickets in the room. So there's a couple answers, but they're all not right? So the company is Boyd Auto Group. You don't hear much about it in the public markets. It's the definition of an unsexy business, right? What do? Boyd Group fixes cars. They own auto body repair shops. So about 11 years ago this month, it traded at $2.30. It pays a dividend. It's paid us back. We recommended it then. It's paid us back around $4 in dividends, so it paid us back what we bought it for. It trades at $180 today, so it's up just under 8,000% over that period. And when I hear people do speeches at events like this, and they say, this is the hot sector to be in, this is the hot sector to be in, I cringe a lot of the time, because if we went back, the correct answer 10 years ago or 11 years ago, where was the hottest place or the best place to put your money? If somebody stood up there and said auto body repair shops, I would have fallen off the stage, because nobody's going to say that. But that was literally the best public company you could have bought at that time. What led us to that business? Not because it's a hot sector, it's because of the great underlying cash flow and the value that we could buy that business at. So I think you don't need to invest in the flavor of the day to make great returns over time, and Boyd is a great example of that. We talked about XPEL. It's one of the best non-penny stock performing companies in Canada over the past 2 years, and they put a little film on a car to prevent annoying scratches and dings. It's all about the cash flow. It's up fourfold over the last 2 years. That's why the stock is up 700%. And the other thing is, when you have cash flow when it's going up, because no stock goes up like this over time, they go like this. So when it's doing one of these 2 years in, it's coming down, you can value the business and say, okay, I'm comfortable that it's trading in that range because its underlying cash flow says it should. Now, if it's a stock based on hype and it's doing this, it's hard to sleep at night, because it's hard for us. If I can't value a business, I've been doing it 20 years, if I can't value a business, I don't think an investor should invest in that. They can speculate on it, but not, and I'm not saying I'm the greatest purveyor of value in the market, or who can hunt out value. But our team, the way we look at the markets, or the way a growth at a reasonable price investor would look at it. If you can't value it based on that, it's not an investment, it's speculation, and just know your capital is at high risk if you invest like that, speculatively long term. Hopefully that makes sense.
Absolutely.
Cool.
Well, thank you so much.
Good.
We can leave it here for now.
For sure.
And once again, I'm Dorothy Neufeld with the Investing News Network.